I warned you. Silver plunges $83 to $75 in brutal crash. Resistance destroys everyone. 1 hour before the crash, a warning was issued. Silver trading at $83 to $1. Then it happened. 10% gone in minutes. But that was just the beginning. $3.6 trillion evaporated across global markets. In 90 minutes, gold, stocks, crypto, all fell simultaneously. This wasn't coincidence. This wasn't market forces. SLV trading at a discount, banks extracting physical, covering naked shorts. The mechanism was invisible to most, but the damage was catastrophic. And the question nobody's asking is, who knew and who's next? Welcome to Financial Crisis Explained. You're here because something didn't feel right about that crash, and you were correct to be suspicious. Now, if you've been watching markets long enough to remember when a handshake meant something, when due diligence wasn't optional, when you verified before you trusted, then you understand why this channel exists. We don't ask you to believe us. We show you the receipts. So if you value that kind of straight talk in a world full of noise, click that subscribe button. Think of it as marking your position, letting us know there's still serious people paying attention. And drop a comment below. Tell us where you're watching from. New York, London, Dubai, Tokyo, Karachi, Mumbai, Sao Paulo, wherever you are. You're part of a global network that refuses to be blindsided. Now let's break down exactly what happened. 1 hour before the collapse, a warning was issued to those paying attention. Silver was trading comfortably between $82 and $83 per ounce. The mood in precious metals markets was cautiously optimistic. Retail investors were celebrating recent gains. Social media was filled with predictions of $100 silver, but beneath the surface, technical indicators were telling a different story. The 150 exponential moving average on the hourly chart was not acting as support. It was acting as resistance. This is a critical distinction that separates professionals from amateurs. When price trades below a major moving average, the structure is compromised. It means institutional money is positioned for downside, not upside. And those who understood this single technical factor saw what was coming. The prediction was specific, not vague, not hedged with maybes. Paper price on silver could go lower, recorded, time-stamped, published. Then, exactly as the technical structure suggested, it happened. Silver didn't drift lower, it plunged from $83 to $75 in a violent cascade, a full 10% drop. But this wasn't just about silver. What unfolded in the next 90 minutes was something far more systemic. $3.6 trillion in global market value simply vanished. Not over days, not over weeks. In 90 minutes, gold, the traditional safe haven, fell 3.76%. $1.34 trillion in market capitalization erased. Silver crashed 8.5%, wiping out $400 billion. The S&P 500 dropped 1%, $620 billion gone. NASDAQ fell more than 1.6%, another $600 billion eliminated. Even cryptocurrency, supposedly independent of traditional markets, dumped 3%. $70 billion destroyed. This was coordinated. Assets that normally move independently all crashed simultaneously. The signature of institutional liquidation was unmistakable. But here's what made this crash particularly revealing. The divergence between Western and Eastern markets. As Western spot prices collapsed to $75, Shanghai spot held at $82, a $7 premium. Shanghai futures were trading at $85. This price differential wasn't random noise. It was evidence of two completely different market structures. In the West, paper contracts dominate. ETFs, futures, derivatives, all settled in cash. In the East, physical delivery is still the standard, and physical silver cannot be created with a keystroke. The Shanghai premium was screaming a message. Real demand for physical metal remained strong, but paper price was being systematically destroyed. Western futures markets showed activity without corresponding volume, prices moving violently. But where was the actual selling pressure? This is the hallmark of sophisticated manipulation, spoofing without the traditional volume signatures. Moving prices through technical trigger points to cascade stop losses. And the mechanism behind this particular crash, SLV, the largest silver ETF, was trading at a heavy discount to its net asset value. This created an arbitrage opportunity for banks. They could extract physical silver from the ETF, use that physical metal to cover naked short positions, and settle their paper obligations, all while driving the paper price down through the very act of extraction. It's elegant, it's legal, and it's devastating to those who don't understand the mechanics, the ones who actually watched the warning video, who understood what resistance means in technical terms, who recognized that price below the 150 EMA indicated structural weakness, They weren't caught off guard. They saw the setup. They understood the institutional positioning. They protected their capital. But for the majority, this crash came as a shock because they confused price with value. They assumed markets were functioning organically. They didn't realize they were participating in a system where paper and physical have completely separated. Current prices. As this analysis is being recorded, Silver Western Spot, $75. Silver Futures, $76. Shanghai Spot, $80. Shanghai Futures, $85. These are not opinions. These are verifiable data points from public exchanges, updated continuously, available to anyone willing to look. The crash of silver from $83 to $75 was not the story. The $3.6 trillion simultaneous evaporation across all asset classes was not the story. The story is what this event reveals about the structure of modern markets and what it signals about the financial warfare being waged. And while most investors were still trying to understand what happened, the real question was already forming. If banks can engineer this kind of crash using ETF mechanics, what else can they engineer? And more importantly, who's positioned for the next move? Most people saw a price crash. Professionals saw a wealth transfer operation. And the difference between those two perspectives is everything. What happened to silver wasn't a market event. It was a mechanical execution, a carefully engineered process that exploits a structural vulnerability most investors don't even know exists. To understand this, we need to go beneath the surface of what an ETF actually is. SLV, the largest silver exchange traded fund, holds physical silver in vaults. Investors buy shares, believing they own a piece of that silver. The ETF is supposed to track the spot price of silver, but here's where the mechanism gets interesting. When SLV shares trade at a discount to the net asset value of the physical silver they represent, an arbitrage window opens, and not for retail investors, for authorized participants, the banks and institutions with special access. They can do something ordinary investors cannot. They can redeem their SLV shares for actual physical silver, take delivery, remove it from the vault, and use it however they wish. Now, imagine you're a bank with a problem. You've sold silver futures contracts you don't actually own. Naked short positions, completely legal in many jurisdictions. You've made promises to deliver silver you never possessed, and suddenly, the price is rising. Your short position is bleeding. You need physical metal, fast, but buying it on the open market would drive prices higher, making your problem worse. Then you notice something. SLV is trading at a discount. The shares are cheaper than the silver they represent, so you execute the arbitrage. Buy SLV shares at the discount, redeem them for physical silver, use that silver to settle your naked short positions. And here's the beautiful part. From a financial engineering perspective, the very act of redeeming SLV shares removes physical silver from the ETF, which forces the ETF to sell, or at least creates selling pressure, which drives the paper price down, which benefits your remaining short positions. You're not just covering your shorts. You're weaponizing the ETF structure itself to drive prices in your favor. This isn't theory. This isn't speculation. This is exactly what the discount to NAV signals when it appears. On the day of the crash, SLV was trading at precisely this kind of discount. The mechanism was armed, and someone pulled the trigger. But let's go deeper. Because this arbitrage alone doesn't explain the violence of the move. It doesn't explain how silver dropped 10% in minutes, or how $3.6 trillion evaporated across multiple asset classes simultaneously. That requires something more sophisticated. Enter the futures market, where leverage amplifies everything. A futures contract allows control of 5,000 ounces of silver with a fraction of the capital. When prices move against leveraged positions, margin calls trigger automatically. Forced liquidations cascade. And here's where timing becomes everything. The crash happened precisely at a technical level that every algorithm was watching. The 150 exponential moving average on the hourly chart. This wasn't chosen randomly. It's a level where institutional stop losses cluster, where automated trading systems have set triggers, where retail investors think they're being smart by placing protective stops. All it takes is enough selling pressure to breach that level, and the cascade begins. Stops trigger, which drives prices lower, which triggers more stops. A self-reinforcing liquidation wave. No fundamental reason, no news catalyst, just pure mechanical execution using known technical levels as weapons. This is what sophisticated spoofing looks like in modern markets. You don't need to place fake orders anymore. You just need to understand where the structural vulnerabilities are and then exploit them with surgical precision. The Western exchanges showed this perfectly. Violent price moves, but volume didn't match the magnitude, because the real action wasn't in the spot market. It was in the derivatives, in the ETF redemptions, in the margin liquidations. Meanwhile, Shanghai told a completely different story. Physical silver still trading at $82, a $7 premium over Western paper prices. Shanghai futures at $85. Why the divergence? Because in Eastern markets, settlement in physical metal is standard practice. You can't create silver with a ledger entry. You can't cover a short by adjusting a database. Physical delivery requirements impose discipline. They prevent the kind of naked positioning that enables Western market manipulation. The Shanghai premium wasn't just a price difference. It was a real-time audit of Western market integrity. And that audit was failing. $7 per ounce between paper and physical, that's not a minor discrepancy. That's evidence of two completely separate market structures. One based on actual metal, one based on financial engineering. And when those two structures diverge this far, someone is getting robbed. The question is, who? Retail investors buying SLV think they own silver. But what they really own is exposure to a mechanism that can be weaponized against them. Physical holders in the East maintain their premiums because their silver can't be arbitraged away through ETF mechanics. This crash revealed something crucial. The paper price of silver is not determined by supply and demand for physical metal. It's determined by whoever controls the largest positions in derivatives and ETFs. And those players have tools that ordinary investors don't even know exist. The arbitrage mechanism isn't hidden. It's published, documented, perfectly legal. But its implications are rarely understood. Until days like this, when the mechanism is activated and billions evaporate, while the sophisticated players cover their positions. This wasn't market volatility. This was financial engineering, executed with precision, and it's far from over. Understanding what happened is interesting. Understanding what to do about it is survival. And there's a vast difference between those two positions. The silver crash wasn't just a trading event to analyze in hindsight. It was a demonstration of how modern financial warfare operates. And if business operators, entrepreneurs, and wealth builders don't grasp these mechanics, they're not just vulnerable, they're predictable. And in markets where algorithms hunt for predictable behavior, predictable means expendable. So let's translate mechanical understanding into strategic intelligence. The first principle, the one that separates survivors from casualties, technical resistance in manipulated markets, is not a suggestion. It's a boundary enforced by those with the capital to enforce it. When price approached the 150 exponential moving average from below, that wasn't just a chart pattern. That was institutional positioning revealing itself. Large players don't hope price goes their way. They engineer the conditions that make it go their way. The EMSA wasn't resistance because of some mystical technical analysis. It was resistance because billions in capital were positioned to defend that level. Understanding this distinction is critical. It means technical analysis in these markets isn't about predicting organic price discovery. It's about recognizing where institutional force will be applied and positioning accordingly, or staying out entirely. This is not trading advice. This is threat assessment. The second strategic insight, the Western paper price versus Eastern physical premium, that $7 gap between $75 and $82 is not trivial market noise. It's a real-time measure of market dysfunction. When paper and physical diverge this dramatically, and one of them is lying, and paper prices, backed by nothing but database entries and legal promises, have a long history of lying. The Shanghai premium is telling sophisticated observers something crucial. Real demand for physical metal remains strong. Industrial users still need it. Jewelry manufacturers still need it. But the price discovery mechanism in Western markets has been compromised. For business operators making capital allocation decisions, this creates a strategic framework. If you're holding paper proxies, ETFs, futures, mining stocks, you're exposed to the manipulation mechanism. Your position can be devalued through arbitrage and derivative pressure, regardless of underlying fundamentals. If you're holding physical metal, you're insulated from paper market mechanics, but you sacrifice liquidity and you pay storage costs. Neither position is perfect, but understanding the trade-offs is non-negotiable. And the third principle, verification over trust. In asymmetric information environments, and make no mistake, we're in one. The ability to independently verify data is a strategic asset. Western spot prices, futures prices, Shanghai spot, Shanghai futures. These are all publicly available on exchange websites, updated in real time, free to access, yet most market participants never look. They rely on news aggregators, on financial media, on summary data, and in doing so, they surrender the ability to see divergences forming. By the time the divergence is explained to them, the opportunity to protect capital is past. Building a personal verification system isn't complicated. It requires bookmarking the right exchange data sources, checking them regularly, noting the spreads, and asking the right question when anomalies appear. Not, why is this happening? But who benefits from this happening? That question changes everything. The fourth strategic consideration, the cascade effect. When $3.6 trillion evaporates in 90 minutes across multiple asset classes, that's not just a number on a screen. That's collateral value disappearing. That's credit lines being reassessed. That's margin requirements being recalculated. For business operators, this matters immensely. Even if you don't hold silver or gold directly, when asset values collapse simultaneously across categories, banks tighten lending standards. Credit becomes more expensive. Business expansion plans get delayed. Suppliers demand faster payment terms. The cascade doesn't stop at precious metals. It ripples through the entire commercial ecosystem. Understanding this means recognizing that defensive positioning isn't about predicting the next silver crash. It's about maintaining financial flexibility when systemic stress events occur. Cash reserves, diversified supplier relationships, conservative leverage ratios. These aren't exciting strategies, but they're what allows businesses to survive and acquire assets when others are forced to liquidate. The fifth insight, counterparty risk in ETF structures. The silver crash exposed something many investors haven't considered. When you hold SLV shares, you don't own silver. You own a claim on a fund that holds silver. And that fund's structure allows authorized participants to extract that silver. Your claim is subordinate to their redemption rights. This isn't a flaw, it's by design, but it means your position can be diluted without your consent. The silver can leave the vault, your shares remain, and the NAV adjusts accordingly. For serious capital preservation, this structure is unacceptable. It's renting exposure, not owning an asset. And the landlord has keys you don't. The sixth principle, recognizing engineered volatility versus fundamental deterioration. Not all price crashes are the same. Some reflect genuine changes in underlying value. Others are mechanical liquidations that create temporary dislocations. The silver crash was the latter. Physical demand didn't collapse. Industrial consumption didn't stop. The paper price mechanism was exploited. Recognizing this distinction in real time allows for strategic response. If fundamentals are deteriorating, exit completely. If mechanics are being exploited, defensive positioning or strategic accumulation becomes viable, but only for those who can distinguish between the two and who have the capital reserves and risk tolerance to act on that distinction. The final strategic framework, patience as a competitive advantage in markets where algorithms execute in microseconds, where leverage amplifies every move, where volatility is weaponized for profit extraction, the ability to wait, to not react, to let chaos resolve itself. That's not passivity. That's strategic discipline. The crash happened in 90 minutes, but the opportunities it created, those unfold over weeks and months. While panicked sellers were liquidating, strategic buyers were making lists, not buying immediately, but watching, waiting for the real bottom, the one that comes after the second wave of forced selling, after margin calls have fully cascaded, after the weak hands have been completely shaken out. That's when assets transfer from the desperate to the patient. This isn't about timing markets perfectly. It's about maintaining the capital and psychological stability to act when genuine opportunities appear. The silver crash from $83 to $75 wasn't the end of anything. It was a demonstration, a showcase of the tools available to those who understand market mechanics, and a warning to those who don't. The question every business operator should be asking isn't, will this happen again? It's, am I positioned to survive when it does? Because it will. The mechanisms are still in place. The structural vulnerabilities haven't been fixed, and the players who executed this operation are still in position, waiting for the next technical setup, the next cluster of stops to hunt, the next opportunity to transfer wealth from the unaware to the informed. Understanding this doesn't prevent crashes, but it prevents you from being the target. And in financial warfare, that's the only victory that matters. The silver crash is already history, but what it revealed is still unfolding. And those who treat this as an isolated event, a singular disruption, a one-time anomaly, have already missed the pattern, because this wasn't the first coordinated liquidation, and it won't be the last. What happened on that day was a case study, a perfect specimen of modern financial warfare tactics. And the real strategic value isn't in understanding that specific crash, it's in recognizing the signature, so you can see the next one forming. Let's establish the pattern. $3.6 trillion evaporated in 90 minutes, not from one asset class, but across all major categories simultaneously. Gold, silver, equities, crypto, assets that theoretically have different risk profiles, different investor bases, different fundamental drivers, all crashed together. That synchronization isn't natural. Markets don't organically move in perfect correlation unless forced. This is the signature of institutional liquidation. When large players need to raise cash quickly, When margin calls hit, when risk limits are breached, they don't sell one asset carefully. They dump everything simultaneously. And in doing so, they create cross-market contagion. The algorithmic trading systems that dominate modern markets amplify this. When one asset class breaks through a technical level, algorithms interpret it as a risk-off signal and automatically liquidate positions across all categories. This creates a feedback loop. Selling triggers more selling, not because of fundamental deterioration, but because of mechanical execution. And here's what makes this particularly dangerous. These events are becoming more frequent, more coordinated, more devastating. The February crash wasn't unique. It was the latest in an escalating pattern, each event demonstrating more sophisticated use of market structure vulnerabilities, each event transferring more wealth from passive holders to active manipulators, each event teaching those paying attention what the next phase of financial warfare looks like. For business decision makers, this matters beyond trading considerations. When asset values collapse simultaneously, credit markets freeze, banks reassess lending criteria overnight. Lines of credit get pulled without warning. Suppliers demand cash instead of terms. The fragility of the entire commercial system gets exposed. A business operator who thinks this is just about silver prices has fundamentally misunderstood the threat landscape. This is about systemic brittleness, about how quickly liquidity can evaporate, how deeply connected today's global financial systems have become, and about how those connections can be weaponized. So how does one build an early warning system, a framework for recognizing when the next event is forming? First, monitor the divergences. Western paper prices versus Eastern physical premiums. When that spread widens beyond historical norms, it's signaling market structure stress. Someone is arbitraging, someone is covering positions, and price discovery is breaking down. Second, watch the technical levels institutional players defend. Major exponential moving averages, particularly the 150 EMA on hourly and daily charts, these aren't magic lines. They're where algorithms cluster their stop losses and entry points. When price approaches these levels with declining volume, it signals weak conviction. And weak conviction at defended levels creates vulnerability to cascades. Third, track cross-asset correlation. When assets that normally move independently start moving in lockstep, it indicates systematic risk-off positioning, large players reducing exposure across the board. This is how institutional fear manifests before it becomes retail panic. Fourth, monitor ETF premium and discount to NAV. When large ETFs trade at significant discounts, particularly in precious metals and commodities, it signals arbitrage opportunities for authorized participants, which means redemption pressure, which means physical extraction, which precedes price manipulation. Fifth, observe volume patterns relative to price movement. When prices move violently but volume doesn't correlate, that's spoofing. That's algorithmic manipulation. That's mechanical execution rather than organic selling. And it means someone is engineering the move rather than reacting to fundamentals. These indicators aren't secrets. They're publicly available data points, updated in real time on exchange websites, free to access, free to verify. Yet most market participants never build the discipline to monitor them. They wait for news to explain what happened, by which time the damage is done. The early warning system isn't about predicting exact timing. It's about recognizing when conditions are favorable for engineered events and adjusting positioning accordingly, not with panic, not with total exit, but with measured reduction of vulnerability, increased cash reserves, reduced leverage, diversified counterparty exposure, and the boring defensive moves that preserve capital when others are forced to liquidate. Now, the larger question, why does this keep happening? Why are these mechanisms allowed to exist? Why isn't market manipulation being addressed? The uncomfortable answer. Because the system is working as designed, not designed for fair price discovery, not designed for retail investor protection, designed for efficient wealth extraction from the unaware. The ETF arbitrage mechanism is legal. The legality of naked short selling differs across jurisdictions. Algorithmic spoofing has evolved to stay barely within legal boundaries. The game isn't rigged in the sense of breaking rules. The rules themselves were written to permit this. Understanding this isn't cynicism, it's clarity. And clarity allows for proper positioning. If you believe markets are fair and will self-correct, you position for mean reversion. If you understand markets are structured for systematic extraction, you position for survival first, opportunity second. That perspective shift is everything. The path forward for serious business operators: build verification habits, check exchange data directly, build monitoring systems, track the indicators that matter, build capital reserves, maintain liquidity for defensive positioning, build knowledge networks, connect with others who see the patterns, build patience, wait for genuine opportunities rather than chasing momentum. This isn't a system you can beat through cleverness. It's a system you survive through discipline. The silver crash demonstrated the tools. The $3.6 trillion simultaneous evaporation demonstrated the scale. The Western-Eastern price divergence demonstrated the fraud. The arbitrage mechanism demonstrated the method. All the evidence is there. For those willing to look, for those willing to verify rather than trust, for those willing to accept that financial markets are battlefields, not investment venues. The legacy being built here isn't about trading signals. It's not about get-rich-quick schemes. It's about education as defense, understanding as armor, verification as weapon. Because in financial warfare, the unaware don't just lose money. They fund the operations of those who saw it coming. Every crash is a transfer. Every liquidation is a harvest. Every panic is profitable. For someone, the only choice is which side of that transfer you're on. And that choice is made long before the crash happens. It's made in the preparation, in the monitoring, in the discipline to position defensively when everyone else is chasing gains. The next event is already forming somewhere in the market structure. The conditions are being set. The technical levels are being identified. The arbitrage opportunities are being calculated. The algorithms are being programmed. And when it comes, the majority will be shocked. They'll demand explanations. They'll blame manipulation they didn't understand was always there. They'll call for reforms that will never come, while those who built their early warning systems, who verified the data themselves, who understood the mechanics, they won't be shocked. They'll be positioned. And they'll be watching for the opportunities that chaos creates. This is the reality of modern markets. Not as they're taught in business schools, but as they actually function. Understanding this doesn't guarantee success, but not understanding it guarantees eventual catastrophic loss. The choice, as always, is individual. Verify everything, trust nothing, and build the systems that let you see what's coming before it arrives.